Coutts' Chief Investment Officer, Alan Higgins. Hi, Alan. It's interesting to hear this 8-year time horizon view, because here we talk about the daily movements, the volatility, and one can easily forget the long term, can't you? And the sense that it makes looking at the long term and the opportunities that are presented in the present.
Yes, you're referring to one of our daily notes that we sent out to our clients, and we showed that valuation is very, very powerful in the long run. So at this kind of level of valuation, 10 times earnings, for example, for the UK, once you go to 8 years or even 5 years in terms of time horizon, high probability of very attractive returns. And we've got quite an unusual situation in many markets where we've got the dividend yield, of course, in the UK, significantly higher than effectively the UK government bond yield. So, for example, we've got equity forwards pricing in lower levels. So, for example, if the UK is currently on a dividend yield of 4%, 5-year gilt yields yield 1%, you've got 3% compound advantage. That starts to work in investors' favour. And so whilst we've got pension funds de-risking everywhere, the private investor has an advantage of picking up this huge income advantage. So, for example, over 5 years, the forward price effectively of the FTSE is about 4,700. So the dividend yield is a very important theme for us also.
And equities, you say, will beat fixed income, but it's the high-yielding equities, going back to what you just said.
Yield is a big focus of what we're doing right now, and obviously last year UK government bonds in particular was the place to be, so valuation doesn't work in the short run, definitively. But yes, we like high dividend yield stocks. Absolutely. 4% is an attractive yield on the UK market generally, but you can get better. We're focused on stocks such as Vodafone, Glaxo, AstraZeneca, centred around a 5% dividend yield and likely growing dividend yield.
And not necessarily falling, because that's a concern. Corporate bonds, emerging market debt, two other themes you're looking at.
Yeah, we've been heavily invested in corporate bonds. For 2011, we wish we had more government bonds. Clearly, you needed duration. Unusually, we did buy a fairly high proportion of very high duration corporate bonds last year. In fact, these are mainly pension fund vehicles that we bought into. We were one of the first wealth managers to buy into this. But a couple of examples from this morning, I think, where you highlight the attractions of corporate bonds. Marks and Spencer's, unlike many sovereigns, revenues in excess of costs, and may not be a stellar performer, but again, making money still. They issued in December with a yield just over 6%. Now, maybe hasn't got the strongest balance sheet, but still is investment grade. And UniCredito, essentially the way we look at it, that's a direct transfer from stockholders to bondholders. If you own UniCredito bonds, pretty good news, this fully underwritten rights issue. It's a bit more difficult if you're a shareholder.
Interestingly, one of your calls in that morning note was for the Yuan to appreciate 4 to 6% annually over the next 3 years. But of course, we've had this disappointing import data today, and some economists I've read are saying, you know, we'll be lucky to see too much of a gain this year because of that factor. Is it worth revisiting that forecast or not? We
still think it's one of the best quality investment decisions out there in terms of, if you like, asymmetry and the sense of going along the Yuan. Effectively, you do it via a non-deliverable forward, so you need to keep an eye on the premium. But so we still think it's quality. From a sterling and a euro base, developments in sterling dollar and euro dollar can be as important. It's a cleaner trade, if you like, from a dollar base. So you have to be a little bit more careful, but it is certainly a high-quality trade. And, I mean, just more broadly, although we are seeing, obviously, a slowdown in Asia and China, generally, as we see today, these markets are more correlated with monetary easing than they are with the economic data.
Alan, thanks for joining us today.
You're welcome.
Higgins there, CIO UK at